Something unusual happened behind the scenes late last year. It didn't make headlines. There was no emergency press conference, no breaking news banner. But within a narrow circle of mining executives, government planners, and industrial buyers, the mood quietly shifted from routine to urgent. It started with a phone call. A Canadian mining executive received an offer that made no sense. An overseas buyer was willing to pay $8 above spot price for physical silver. No negotiation, no demand for discounts, immediate settlement. Within hours, another buyer called. This time the premium was $10 above market. Cash, fast delivery, no questions asked. In a normal market, that behavior would be irrational. No sophisticated buyer willingly destroys their margin unless something more important is at stake. These weren't retail investors chasing momentum. These were institutional players with access to better data, better intelligence, and a clearer view of the supply chain than almost anyone else. They weren't speculating, they were securing supply. That single detail changes everything. Because when buyers stop caring about price and start caring only about availability, the market has already shifted, and most people won't realize it until the rules have changed completely. Over the next several weeks, a pattern emerged. Similar reports surfaced from Europe, Asia, and parts of the United States. Industrial users were quietly paying premiums well above exchange prices for guaranteed delivery. Physical metal was being pulled out of circulation, not because silver was cheap, but because access itself was becoming the scarce resource. That forced one unavoidable question. What do these buyers know that the rest of the market doesn't? The answer lies not in rumors, not in speculation, but in policy. Specifically, in a sequence of decisions made quietly in late 2025 that fundamentally altered the global silver market. To understand what's happening now, you have to start with a date most people ignored, January 1st, 2026. While much of the world was celebrating the new year, a policy quietly went into effect on the other side of the globe. It wasn't dramatic. It wasn't framed as a ban. It was written in technical language, buried deep inside trade documentation. But its impact was profound. China implemented a new export licensing framework for silver. This wasn't a blanket prohibition. It was something more effective. A system of controls that determined who could export silver, how much, and under what conditions. Only companies meeting strict criteria would be approved. Large producers with strong state ties, smaller refiners, and independent exporters were effectively shut out. In practical terms, this meant one thing. Silver could still leave China, but only when China allowed it. This matters because China doesn't just mine silver, it dominates silver refining. Between 60 and 70% of global refining capacity runs through Chinese facilities. When refining is restricted, the entire downstream supply chain feels the impact. In the first 11 months of 2025, China exported more than 4,600 metric tons of silver. During that same period, it imported only about 220 tons. That difference supported manufacturing across Europe, North America, and Asia, now that flow is no longer guaranteed. And while Western media largely ignored this shift, something else happened almost immediately afterward, this time in the United States. In November 2025, silver was added to the U.S. government's official list of critical minerals for the first time in history. This wasn't symbolic, it wasn't political theater. It triggered a specific legal framework with real consequences. Critical mineral designation means priority treatment during supply disruptions. It opens access to expedited permitting. It allows federal agencies to invoke the Defense Production Act to secure supply. The timing wasn't accidental. China restricts exports in October. The United States designates silver as critical in November. Implementation begins in January. These are not coincidences. They are responses. For decades, silver lived in an odd category, too industrial to be treated like gold, too monetary to be treated like copper. It was undervalued precisely because it sat between worlds. That era is over. Silver is now officially recognized as a strategic industrial material. Essential not just for markets, but for national infrastructure, defense systems, and energy security. And once governments reach that conclusion, markets stop being free in the way people assume they are. To understand why this matters, you need to understand what silver actually does in the modern economy. Not as an investment, but as a physical input. Silver has the highest electrical conductivity of any element on Earth. That's not a marketing claim. That's physics. No substitute matches its performance at scale. Copper is cheaper, but less efficient. Gold is effective, but far too expensive for mass deployment. Every smartphone, every data center, every solar panel, every medical device, every power grid component depends on silver. The energy transition alone consumes hundreds of millions of ounces annually. Solar photovoltaic demand continues to set new records year after year. Electric vehicles use significantly more silver than internal combustion vehicles. Advanced driver systems, power electronics, battery management, all require silver-based components. Defense systems rely on silver in guidance systems, communications equipment, satellites, and high-performance batteries. These aren't optional applications. There are no substitutes. And here's the part most people don't understand. When silver is used in industrial and military applications, it is destroyed. A missile doesn't get recycled. A solar panel installed on a rooftop isn't coming back into circulation for decades. Medical instruments wear out. Electronics get discarded. This is consumptive demand. And that demand has been exceeding supply for years. According to industry data, global silver demand surpassed supply every year since 2021. By 2025, the cumulative deficit exceeded hundreds of millions of ounces. The difference wasn't filled by new production. It was filled by inventories. Those inventories are disappearing. Exchange warehouses have seen dramatic drawdowns. Physical stockpiles in Asia are at multi-year lows. Above-ground silver that once acted as a buffer is being absorbed into long-term use. When that buffer runs out, markets behave differently. Price stops being the only signal. Availability becomes the signal. This is why those phone calls mattered. Those buyers weren't reacting to charts. They were reacting to policy and supply constraints that hadn't yet been priced in. Now we need to talk about the law that makes all of this more serious than most people realize. The Defense Production Act. Passed in 1950 during the Korean War, the Defense Production Act gives the U.S. government broad authority to prioritize and allocate materials deemed essential to national security. It has been used repeatedly, not hypothetically, but actively. During the pandemic, it was invoked to secure medical supplies. Manufacturers were required to fulfill government orders before selling to the public. During semiconductor shortages, it was used to direct investment and production. This law is not dormant. It is operational. And once a material is designated critical, it becomes eligible for these authorities. This does not mean confiscation. It doesn't mean police knocking on doors. That's not how modern resource control works. It means priority allocation. If the Department of Defense places a rated order for silver, that order must be fulfilled before commercial demand. Mining companies comply because the law requires it. What remains enters the civilian market. If supply is tight enough, that remainder can shrink rapidly. This is how strategic commodities are controlled in the modern world. Not through dramatic seizures, but through quiet allocation. And history shows exactly how governments behave when strategic materials become scarce. During World War II, the United States quietly removed hundreds of millions of ounces of silver from government vaults to support the Manhattan Project. Copper was needed elsewhere. Silver replaced it. The public didn't find out until decades later. During that same period, copper pennies were replaced with steel because copper was redirected to war production. Markets adapted, civilians adjusted. The government got what it needed. That pattern hasn't changed. Only the mechanisms have. Today, instead of wartime seizures, governments use licensing, allocation, and investment frameworks. The outcome is the same. Resources flow where governments want them to flow, and silver has now entered that category. This doesn't mean the retail market disappears overnight. It means something more subtle, and often more impactful. It means supply becomes less reliable, premiums widen, delivery times stretch, access becomes inconsistent. Those who already hold physical metal are unaffected. Those who try to acquire it later may find that price is no longer the limiting factor. Availability is. This is why the designation of silver as critical matters far more than any short-term price movement. It marks a shift in how governments view the metal, not as an investment asset, not as a speculative commodity, but as infrastructure. And once a material becomes infrastructure, markets stop behaving the way textbooks describe. In the next phase of this investigation, we'll examine how these policy shifts intersect with collapsing inventories, inelastic industrial demand, and global geopolitical competition, and why the window most people assume they have may be far smaller than they think. For now, understand this. Silver didn't just rally. It didn't just break resistance. It crossed a line. And once that line is crossed, the rules change, quietly, systematically, and permanently. What most people still fail to understand is that silver is not facing a temporary shortage. This is not a shipping delay. This is not a speculative squeeze. This is a structural breakdown that has been years in the making, and it is now accelerating faster than the market can adjust. The silver market has been running persistent deficits for multiple consecutive years. This is not a matter of opinion. It is documented by industry data, mining reports, and supply-demand audits. Global demand for silver now exceeds global supply, not occasionally, but consistently. And every year that deficit is filled by one thing only: existing inventories. Those inventories are being drained. For decades, above-ground silver stockpiles acted as a shock absorber. When demand spiked, inventories filled the gap. When supply fell short, vaults compensated. That system worked when deficits were rare and small. It does not work when deficits become structural. By 2025, the cumulative deficit reached hundreds of millions of ounces. That silver didn't vanish into speculation. It was consumed, installed, embedded into solar panels, electronics, vehicles, medical devices, and defense systems. Once silver enters those applications, it is effectively removed from circulation for decades, if not permanently. This is where the supply story becomes uncomfortable. Unlike most commodities, silver supply does not respond efficiently to price. Roughly 3/4 of global silver production comes as a byproduct of mining for other metals such as copper, lead, zinc, and gold. This means silver miners do not decide how much silver to produce based on silver prices. They produce silver only insofar as it comes out of other mining operations. Even if silver prices double, copper miners do not suddenly double silver output. Their economics are driven by copper. Silver is incidental. This breaks the normal market mechanism. In a typical commodity market, high prices incentivize new supply. With silver, that feedback loop is weak, slow, and often non-existent. New primary silver mines take years to permit, finance, and build. Environmental regulations, declining ore grades, political instability, and capital constraints further delay production. The result is a supply curve that is rigid at precisely the moment demand is becoming explosive. Now consider what is happening on the demand side. Industrial demand for silver is not discretionary. It is not driven by sentiment. Solar manufacturers do not wait for a dip. Defense contractors do not delay procurement because prices are high. Semiconductor producers do not redesign entire systems to save a few dollars per ounce. Silver is used because it works, and in most applications, it cannot be substituted without sacrificing performance, reliability, or safety. Solar energy alone now consumes roughly 1/5 of global silver demand, and that share continues to rise. Governments around the world have committed trillions of dollars to renewable energy targets. Those commitments are locked in by policy, regulation, and contracts. Electric vehicles add another layer of pressure. Each EV uses significantly more silver than a traditional vehicle. As production scales globally, silver consumption in the automotive sector rises in parallel. Artificial intelligence infrastructure compounds the problem. Data centers require massive amounts of high-performance electrical components. Every increase in computing power translates into increased silver usage. This demand is growing simultaneously across multiple sectors, and it is growing faster than supply can respond. At the same time, physical inventories are collapsing. Exchange-tracked silver stocks have fallen dramatically from their peaks. Warehouses that once held comfortable buffers now operate with minimal surplus. In some regions, reported stocks are at multi-year or even decade lows. The silver that remains above ground is increasingly concentrated in strategic hands. Governments, defense contractors, and industrial users who have no intention of reselling it. This changes market behavior fundamentally. In a normal market, price discovery happens through marginal trades. Buyers and sellers negotiate until equilibrium is reached. But when supply becomes scarce and demand is inelastic, price stops being the primary clearing mechanism. Allocation replaces price. This is already happening quietly. Industrial buyers are securing supply through long-term contracts, private deals, and off-market transactions. They are willing to pay premiums above spot because their concern is continuity of production, not short-term profitability. This is why mining executives are receiving offers that appear irrational. Those buyers are not speculating. They are insulating themselves from future disruption. Now add government behavior to this equation. When a material is designated as critical, governments do not wait for markets to fail before acting. They prepare in advance. They build legal frameworks, identify vulnerabilities, and map supply chains. The Defense Production Act There's a moment in every market cycle when price stops being the most important variable. Silver is approaching that moment now, when availability becomes uncertain, when governments begin planning instead of reacting, and when industrial buyers prioritize security of supply over cost. The market enters a different phase entirely. This is the phase where silver no longer behaves like a normal commodity. Most investors are trained to think in terms of charts, support levels, resistance zones, and price targets. Those tools work well in liquid, freely traded markets. But strategic resources operate under different rules. When a metal becomes essential to national infrastructure, defense, and energy security, governments do not leave its fate to open markets. They manage it. The moment silver was designated a critical mineral, it crossed an invisible line. That designation is not symbolic. It changes how policymakers view the metal. It changes how agencies coordinate supply. It changes how producers are incentivized and how demand is prioritized. This does not happen overnight. It unfolds in stages. First comes recognition. That stage has already occurred. Silver is now officially acknowledged as essential for electrical systems, renewable energy, advanced manufacturing, and defense applications. That recognition alone alters long-term planning assumptions. Second comes preparation. Governments begin mapping supply chains, identifying vulnerabilities, and assessing domestic production capacity. This is already underway. Investment programs, strategic assessments, and interagency coordination are now part of the silver equation. Third comes intervention. This stage is not always dramatic. It does not require public announcements or emergency decrees. It can occur quietly through procurement contracts, export licensing, priority ratings, and financial incentives that steer supply toward preferred uses. By the time intervention becomes obvious to the public, it is usually well advanced. This is why historical comparisons to past precious metal events often miss the point. The modern approach to strategic materials is not confiscation. It is control through structure. When governments need supply, they do not need to seize assets. They simply ensure that production flows where they want it to flow. The private market adapts around that reality. This has consequences. Retail availability becomes unpredictable. Premiums rise independently of spot prices. Delivery times stretch. Access favors institutional buyers with scale, contracts, and political relevance. This is already visible in fragments across the silver market. Dealers report inconsistent supply. Industrial buyers negotiate privately. Mining companies receive unsolicited offers at prices that ignore public markets. These are early signals, not anomalies. Another critical shift is psychological. When participants realize that silver is no longer abundant, behavior changes rapidly. Hoarding replaces trading. Long-term holding replaces short-term speculation. Once that shift occurs, liquidity evaporates. Markets do not collapse in that phase. They tighten. And tight markets behave differently. They gap instead of grind. They move violently instead of smoothly. They punish those who assume yesterday's access guarantees tomorrow's. Now consider the broader macroeconomic backdrop. Global debt levels continue to rise. Governments face increasing pressure to finance spending without destabilizing bond markets. Inflation remains persistent, even when official measures attempt to downplay it. Real purchasing power continues to erode. In such environments, tangible assets regain relevance. But not all tangible assets are equal. Silver occupies a unique position. It is both monetary and industrial. It functions as a store of value and a consumable input. This dual role amplifies its sensitivity to structural shifts. Gold responds primarily to monetary conditions. Silver responds to monetary stress and industrial demand simultaneously. That combination is rare. As global investment capital searches for assets that protect against currency dilution while remaining essential to economic activity, silver naturally attracts attention. But investment demand is only one layer of the story. The deeper driver is necessity. Solar panels cannot be produced without silver. Electric vehicles cannot function without silver. Defense systems cannot be built without silver. Medical technologies cannot operate without silver. This is not optional demand. It does not retreat when prices rise. That reality creates a powerful asymmetry. Supply responds slowly, demand persists, inventories decline, and governments notice. Once governments notice, markets stop being purely economic. This is where most retail participants underestimate risk. Not downside risk, but access risk. The risk is not that silver falls to zero. The risk is that silver becomes difficult to obtain at posted prices. History is filled with examples of markets where prices appeared stable until availability vanished. Energy markets, food markets, industrial materials during wartime. In each case, those who secured supply early were insulated. Those who waited competed later under worse terms. Silver is not immune to this pattern. Now, does this mean silver will only rise? No market moves in a straight line. Volatility will remain extreme. Corrections will be sharp. Paper markets will continue to experience violent swings as leverage resets and speculative positions unwind. But beneath that volatility, the structural foundation is shifting. Once a metal becomes strategic, it rarely returns to its previous status. The window that exists today is not about chasing price. It is about recognizing transition. Markets reward those who position before transitions are obvious. Once consensus forms, the advantage disappears. This does not mean reckless action. It means informed consideration. It means understanding that silver's role in the global system is evolving, and that evolution has consequences for pricing, availability, and behavior. For many years, silver was dismissed as secondary, a lesser precious metal, a speculative alternative. That narrative no longer fits reality. Silver is now embedded in the infrastructure of modern civilization. It is embedded in energy grids, transportation systems, digital networks, and defense architectures. When a material reaches that level of integration, it stops being optional. That is the key takeaway. This is not about hype. It is about alignment between policy, industry, and physics. Electrical conductivity does not change. Manufacturing requirements do not disappear. Strategic competition does not slow down. These forces are cumulative. What happens next will not be announced on financial news tickers. It will unfold through policy implementation, procurement decisions, and supply chain adjustments that most people never see directly, but their effects will be felt. Those effects may include higher premiums, restricted availability, and sudden repricing events that catch markets off guard. By the time headlines acknowledge the shift, positioning will already have occurred. That is how strategic transitions work. If you've stayed through this entire analysis, you now understand something most market participants do not. Silver is no longer just trading. It is transitioning. What you do with that understanding is up to you. If this breakdown helped you see the silver market more clearly, make sure to like this video so more people can find it. If you know someone who still thinks silver is just another commodity, share this with them. And if you want to stay ahead of developments that rarely make headlines until it's too late, subscribe to the channel. We'll continue tracking these shifts as they unfold. The most important moves in markets happen quietly, long before they become obvious. Thank you for watching.